Okay, so let's do a presentation here about capital investment decisions and cash flow estimations. Um, and as always, the goal here is to provide a little bit of efficiency, distilling down some things from our text and stuff, to let you know things that are super interesting to us, me in terms of writing graded items and hints to keep in mind, pitfalls I've seen students fall into, and hopefully avoiding them and that sort of thing. So the goal in presentation is always to try to provide something that so it makes your life easier, more directly connects to the graded material rather than just throwing the book at you. But as always, your book is there, right? And as always, plenty of practice items to do and to consider online, right? And that's sometimes for some people an even more important tool. And then of course I'm always available if there's something specific that you need some assistance with. I'm always just a message away, kind of thing. So the kind of the biggest topic of this chapter is, well, where do these cash flows come from? Because we've certainly done some enough NPV talk here, right? We're like, oh, we have a project right at time zero that costs 100, right? And then it brings in 30, say, and 70 and another 50, that kind of thing. Where do these numbers come from, though? Like, in a text setting where you're just in an academic class, the answer is, well, I give them to you, right? Or the book problem gives it to you, or whatever. They're assigned, they're given to you to utilize. And you can do things like your decision criterias with them, especially NPV and stuff. But what if I wanted to find them for myself? Because in a real world setting, I probably wouldn't have them just fall out of the sky. I might have a real need to actually construct them. So that's a big topic here for today's presentation, along with some concept things like, well, what pieces should go into the puzzles making the minus 100, 30, 70, 50, and what things should not count when going into those. And then a few other kind of side topics to keep in mind here as well. So that's the big topic of today's presentation, right? It's difficult, right? There's a reason that it's more attractive to just have these things fall out of the sky, right? To actually go to all the trouble of all the work of coming up with the cash flows that a project is going to create is a big piece. It's a big amount of work. It's a big amount of work. So you'll even kind of see that here as we work via an example to come up with some operating cash flow estimates. You got to worry about salvage value at the end of projects. You got to worry about these upfront costs, and you're doing so all under the guise, all under the label of incremental cash flows, right? So having a couple thoughts pop in my mind simultaneously here that I want to get out of my mouth. So incremental cash flows are a very important vocabulary type thing. So you really want to be familiar with this concept of incremental cash flows, right? They're the ones that are determined by the choice of accepting or rejecting a project. Right? Your decision to take on the project, right, if that brings in a cash flow, then it's incremental. Or if your decision to start a project stops an old kind of cash flow, that's also incremental and should be included when you're analyzing a project, right? If your decision to reject a project, right, stops a certain cash flow from coming in, that is a cash flow that you would want to be considering, right? If you're rejecting, right, allows an old type of cash flow to continue, right? Right. But the opposite of this would be like, right, cash flows that occur or not, regardless of whether you accept or reject, those should not be considered. They should not count. They're not incremental. Right? That's the opposite, if you will, of incremental. And the idea when you're doing cash flow analysis tied to a project, right, Incremental costs, the ones that are determined by your choice to do the project, those do matter. Others do not. And we'll give some examples and stuff of those sorts of things here shortly. All right, so that's one to keep in mind. And then another thought just kind of popped in my head too as I was kind of going through that, which is the similarity between NPV, right, for projects and price estimation, like intrinsic valuation, say for stock. Like, there's lots of similarity. Lots of similarity, right? In both cases, you're talking about a value of something. In both cases, you're talking about estimating future cash flows, maybe dividends in the term of intrinsic value, right? Or in the case of a project, the incremental cash flows. You're trying to estimate future cash flows in one form or another, but get their present values, right? Because they're going to occur in the future. And when you get the present values of all the future cash flows, whether you're talking about for the value of a stock or for the value of a project, right? You now have your value estimate. And at the super macro level, firms that do a good job of getting a lot of positive NPV projects, right, will see their stock prices increase, right? Because that's a way to add value to the firm, right? And then that value back to the shareholders, say. And so there's a lot of overlap with all this stuff, and that's more just motivation of why this sort of attack or this sort of thinking is important. Okay. Let's see. We want to worry about cash when it actually happens. So if we have a situation for like, an accounts payable, buying something on credit sort of thing, well, that's not a cash sale, so it's not part of your cash flow estimate. And the same thing happens on the flip side with like an account receivable sort of thing. So, changes in working capital are something to sort of keep in mind. Right? And we're going to be careful about accounting for our cash when we do so. Right? So, but I really think that's best kind of seen via example here because the way of dealing with your outlays and charges and stuff, it's going to be relatively one of the easier parts of this sort of work actually. So it's hard to parse out the non-cash charges versus and their impact, but there's a specific way to do it and kind of textbook problems here that say I think I probably scared you too much for the last 30 seconds or minute there, so just hang tight about that. One thing to please do keep in mind: financing costs like interest expenses are not included in your cash flow estimations, right? So that's weird, right? But your cash flow estimates don't include financing costs like interest that you owe to your debt holders. These costs do show up, however. They show up in a sneaky way, right? When you have costs, your interest and your cost of retained earnings and all that kind of stuff, they don't actually show up in your free cash flow estimates in the numerator, but the higher your costs of financing, the higher your discount rate in the denominator is. So these costs show up in sort of an indirect way, which is, right, when they're higher, your K is higher, so that you, instead of 8%, for example, would be 0.08, or 11%, you have 0.11. And the higher your cost, the higher your K. And then when you use your K, right, in your valuation to get your NPV or your stock price, if you were thinking of it that way too, right, when you do that, it makes the NPV lower when your K is higher, right? Because your denominators in these things are taking down the value of the individual cash flows that you're projecting to make. But it's strange a lot of times for folks to see. You're talking about, well, all that matters, what's incremental, what's incremental, what's incremental? And when we say, well, maybe your financing costs are incremental, right? Because I have to borrow, for example, and take on new debt and pay new interest if I'm going to do this project. That's all fair and true, but in this extra case, this is kind of a special case, right? These financing costs are a special case. And they still are incremental, right? Included, but they're incrementally included in this subtle way via the denominators, if you will. Okay. Right, so there's the terminology, right? Incremental cash flows, those are the ones that matter. Sunk costs are something that you should ignore. Sunk costs are ones that have already happened. For example, you commissioned a study to consider doing a project. Right? Well, if you spend $1 million on the study, then that has no bearing on your cash flow estimates of the actual project. That's already in the past when you've come to the fork in the road where you accept or reject. I got a lot of concept type questions out there, right, regarding sunk costs. So you really want to make sure that you're comfortable with the idea of a sunk cost and the idea that they're not included when you're trying to do cash flow estimations and analysis, sort of thing. Opportunity costs are considered, and they're kind of a subtle one, probably not as subtle as this financing cost thing I was talking about a minute ago here. But an opportunity cost is money that you're giving up, right, when you decide to do a project. So a classic example there would be you have some extra space in a facility and you're considering using that space to begin a new project, like on your property. And in the interim, you had been renting out this space to a third party. Well, that rental income that you've been taking in is now, right, going to be gone if you take on this new project and use the space in your warehouse for that instead, or in your facility. That's an opportunity cost. You're giving that up. You would have had it, right, if you continued rejecting this product. And when you accept the project, that rental income goes away. So that's an opportunity cost, and that's an incremental thing that would indeed be included, right, when you're doing cash flow analyses. Right, so that's another one to be ready for. These are concept things that you want to be ready for here from the chapter that might be come back at you here. Another would be externalities. An externality is the effect of one product or one part of a firm's dealings on the whole. Right, so if, for example, you can have positive externalities or negative. Right? So externalities can be both good, where they actually improve your cash flow estimates, or bad, where they hurt your overall cash flow estimates. They can be good or bad. And a good one would be a complement, and a bad one would be a substitute. And the example here would be a good externality might be a cell phone company that's making new phones. Say you have another iPhone 88, right? And something like that, and then they sell phone cases because of it. Right? The cash flows generated by selling the cases are an incremental cash flow, a complement that should be considered for the sale of the phone. They would not have been made possible but for the phone sales. Right? A bad type of externality, a substitute that kind of hurts your overall setup, would be what happens if you have a new flavor of a soda, like for me, some kind of a diet soda, and you come up with a new 0-calorie version, and all I do is I switch to your new version, but I just stop drinking, Diet Coke. Say we're talking about Coke, and Coke comes up with a new 0-calorie thing, and I still buy as much Coca-Cola product, but all I do is switch over from drinking the old Diet Coke kind of thing. Well, in that case, the cash flows that you've generated from me for your company, right, are really zero. All you did was switch over from my previous cash flows to the current one. So when you subtract the negative externality there, you actually recognize that in my case, you have a zero cash flow from that project of potentially bringing out a new flavor kind of thing. And that's an example that should, again, be considered. Right? So knowing some of the things that should and should not be considered in your cash flow analysis, that's an important topic. That's an important concept topic that you definitely want to be ready for. That sunk cost one I know gets asked about a lot. Right? We try to, in a perfect world, you actually note your cash flows exactly when they occur, right? But we're going to kind of quickly use more of a timeline sort of thing, because that way we can break it into a more manageable exercise. That way all the cash tends to come at the end of a quote-unquote year, And of course, that's not realistic because you have cash flow come in March and in June and in September and November and everything, right? So to do this more discrete thing where all the cash flow comes in at just like the period end, and we usually use years, is being a little bit unrealistic to the real world. But hey, we are after all doing an estimate here. In the big picture, like the activity here is not that unrealistic. This isn't just an academic thing. The corporations themselves, when considering these sorts of things, tend to even use kind of the more discrete year-end type of focus on this sort of thing. Now, depreciation is a non-cash charge, but dealing with depreciation is going to be something that you want to know how to do. And sometimes depreciation numbers change, or tax numbers and the rates that you can use and stuff on these sorts of things. So you'd always just want to use whichever rates are given to you when you're doing a problem, like say from our text or something like that. And then in a real world setting, you can look up the real tables. But you definitely want to understand, right, how depreciation is factored into your cash flow analysis. And the idea of it is basically that you can use it as an expense to kind of shield yourself from taxes. So you subtract depreciation before you end up calculating your tax bill, but then you get to add that depreciation amount back in after the tax calculations, and it ends up being, again, a shield where you're better off for having it in terms of an expense. And it surprises a lot of students at first, but it's really oftentimes advantageous, typically advantageous, to depreciate the value of assets as quickly as possible. That surprises people because depreciation is generally thought of as a bad thing. Well, it is a bad thing for the household user and stuff, but assuming you've already bought assets, right, just assuming they're already bought, then you want to depreciate them quickly because you like to save or shield your dollars as early as possible. That's the whole idea of present value in dollars earlier in the timeline being more valuable than dollars later, sort of thing. Right? The maker's depreciation schedule, and there's different ones for different lengths of times of assets, is one. This is a topic that you'll want to be familiar with, right? And you'll even want to be, so you'll be able to look it up, right? But you'd want to get comfortable working with the actual maker's depreciation schedule and say having an example asset that's going to depreciate and you knowing how to do it and how much depreciation dollars to say depreciate in year 1, 2, 3, 4, 5, for example. Right? You'll want to be able to use this thing. Again, the MAKERS is the acronym for Modified Accelerated. I forget the whole thing even sometimes, right? But this is a way to depreciate assets and quickly. It usually allows you to write off a lot of the value early in the life of the assets so that you can save tax dollars somewhat quickly. And it's kind of a government incentive type thing to sort of encourage businesses to spend for the sake of increased production, right? And therefore kind of give a little economic boost sort of thing. Not only is the purchase price, like the sticker price, if you will, of an asset depreciable, but so are any shipping and installation type costs that are tied to it as well. Those will also be included in the depreciation framework, right? There's no set formula for estimating cash flows for all projects. Every project is going to be a bit different. So say a lot of times we actually get a lot of feedback and input from marketing and from advertising and from market consultants and all sorts of things to try to get a feel for sales estimates that might come to doing a new project. And then down the river from those sales estimates eventually becomes the cash flow impact, right? So we've got some guidelines here coming up in terms of what you would do in setting up your cash flow estimates, but every project is going to be quite unique in terms of what it does, what the projected type of sales are. Are they growing? Are they shrinking? Some products just get more popular over time. Others have sort of a honeymoon era, and then after a while they don't really sell much anymore, and things like that. And of course, all different lengths of time for the actual horizon, if you will, of a project are out there too. But usually projects come with an initial cost. So the opening cash flow is usually negative. You're used to that from like our NPV type work, right? Where your CF0, your initial cash flow, right, has been a negative number. Well, where does it come from? The sticker price of it, or whatever it was you bought. Like what did you pay for it? Plus any shipping and handling and installation costs, as we just set a slide back. That's a concept that you want to make sure you're comfortable with. That right, that the total cash flow for your initial outlay is not just the purchase price, but also shipping, handling, and installation. Um, let's see what else. You'll have to, or you'll get to sell some current, some old, if you will, assets sometimes to begin a project, and any revenue or cash flow, excuse me, that you generate for that after tax is an incremental cost that, it depends on whether or not you did the project, right? So those would be included if applicable. So that makes problems where you're replacing old equipment potentially a little more complicated than projects where you're just doing brand new machinery for the first time, say. And then increasing in net working capital beyond that covered by spontaneous accounts. What's that all about? Well, it's the idea that a lot of times when you start a new project, you're increasing the size and scope of operations sometimes, and therefore you need to keep, say, more inventory on hand, or keep extra investments money on hand, or things like that. And if you're tying up extra cash in the company because you've decided to do a project that makes you a bigger company, and you now have to keep extra, again, say, inventory around, then that's a cash impact that we're going to want to include as well. Now, like I mentioned 4, 5, 6 slides back, don't be too freaked out about this, because it's actually relatively standard to do. And I think when we do some of it via example here in about a few slides, you'll see that it's not that hard to execute with the kind of book problems and stuff that you'll be given. Okay? And then that's your initial outlay. Right? This is kind of, if you're thinking of, say, maybe a 3-period project or something, right? So you're going to have some costs, particularly your initial outlay would be at time 1 or 0. I'm sorry. Initial outlay, right? Negative, right? Sticker, shipping and handling, installation, change in net working capital. These are all things that will, cost money, and you get to depreciate. You'll get to depreciate away later, but the cash impact on them here, right, is going to be negative. And then you're going to have some operating cash flows for, say, 3 years. So you're going to have like OCF 1, OCF 2, OCF 3. And then if 3 is indeed your last period, then you'll have a terminal year effect as well. Right? That's going to include things like getting your, right, if this was minus, you're going to get your net working capital change back because the project's over. Don't worry, again, we're going to talk more about that in a little bit. Right? Salvage, that's scrapping your things that you bought. Now that it's over, can you scrap them? Can you sell them? Can you have a company garage sale and get something for them? But if you do, you might have to pay tax on salvage. So you have some special case stuff, some terminal work. So a few extra things that will happen in the last period of a project. I do think, though, I might be being too vague with some of this, where I think an example framework here is going to make a lot of this seem a little less wishy-washy and a little more doable. Right? So, for example, just take a piece of equipment. $200,000 cost. These might all be in thousands, by the way, right? So we might be doing a $200 million project. $10,000 of shipping and cost, $30,000 in installation cost, makes for a grand total of $240,000, right? All depreciable. So that's your initial outlay. Let's make this one even longer. Let's do a 4-year economic class. So that means that this, economic life. That means this project is going to run for 4 years. Right? So that wouldn't include year 0. That's going to include years 1, 2, 3, 4. And this thing might have cost you $240,000, right? That you're out cash. But at the end of this project, after 4 years, it's not worthless. You can actually sell it. I always kind of envision having some sort of garage sale, and you get $25,000 for selling it. You might have a tax implication to that, though, so hold your horses a little bit about the $25,000 salvage value. In some cases, you don't get to keep all the cash. You might owe tax on any profit that you have above its book value. And you need detail about the depreciation status of the asset. The IRS clarifies all sorts of different kinds of assets and gives the options and the rates for how they can be depreciated. Again, you'll be able to look up makers depreciation type numbers and or be given them, but I think here with this little example you'll be able to get the most important piece of all, which is executing how you actually kind of parse out the depreciation expense over a number of years. Well, why are you doing this? Why are you spending all this money? To generate profit, right? You're going to sell another $250,000. We'll keep it the same, $250,000 of increased sales every year for 4 years. Now, you're also going to have costs with the increased sales. You can imagine you're doing some sort of manufacturing thing here where, yeah, your sales are going to go up with, say, this new project you're doing, but you're also going to, burn through more raw materials, right? More operating costs sorts of things. So, yeah, your sales are up 250, but your incremental costs are up 125 a year. So you can already envision at the top line, you're going to be making around 125,000 in gross profit in the top couple lines right away. But we got to see how the rest of the pieces shake out as well. You'll be given tax rate and cost of capital information for these. Knowing actual tax rate information is not that difficult to do for companies, typically speaking. But the cost of capital is something that can be quite challenging in the real world. In this case, to get you rolling, we'll just give you a number. In this one, it's 10%. One thing to keep in mind, I think they mentioned it in the book quite a bit, is if you might have a company WACC, weighted average cost of capital, 10%, versus a project WACC, right? And if you have a riskier project, right, then you don't just use the standard company WACC. You'd use this company WACC plus some incremental amount, right? And if it's more conservative, I don't know, a safer project, then rather than just using the full WACC, you might deduct a little bit. Your WACC might be, so if your standard company WACC is 10%, you might have a riskier project and you need to use 12% as your discount rate. Or you might have a safer project and you might use 9% as your discount rate. And say, practically speaking, in something like a graded question, I'd have to give you more information by which to know exactly the amount to do it by. But the concept of potentially using a higher rate for riskier and a lower rate for less risky is something that you want to be ready for, like say for a concept type question. All right. Here's the pretty easy example, right? They say, well, here's your initial outlay, right? $200,000 of equipment and $40,000 of cost. Right, in this little example. By the way, I'm trying to make sure. I don't think we did anything. We didn't have any information about any change in net working capital in this one. Right, so some of these projects you have to pay even more cost on period 0 to increase your net working capital, and then you recover it, like we were saying in the last period. But this example here, I don't think has that. And I was just kind of going back and checking. Well, there's your $240,000 of depreciable investment. How does that break down? Well, the maker's schedule will tell you exactly how. You need to look up the correct, right? You need to look up the correct schedule. It's weird. It's very annoying. But the 3-year depreciation, it says due to a half-year convention, right? A 3-year asset's actually depreciated over 4 years, right? Well, that's because a little bit of it would be coming during year 3 is the idea. And so, well, let's do some of the depreciation at time 3 and some of it at time 4. Otherwise, it looks like the entire value of the asset is done after 3 years. And say a 3-year asset is more technically thought of as 3.5 years, sort of thing. More detail in the text and such as well, but it's very strange to people, and me too, that if you think, oh, if I'm going to have a 3-year class asset, then that means the depreciation must all get parsed out into one of 3 years, 1, 2, and 3. And it's like, nope, it's actually spread out over 4 different years, 1, 2, 3, and 4. And you see the rates there that add up to 100% are 33%, 45%, 15, and 7. Those are the rates that you apply to your depreciable basis. You saw that term in the slides a while ago, right? So that means almost a third of your depreciable asset here, so about almost 80, so 79, of the value you can claim as a depreciation expense in the first year. And then you can claim a whole other $108 in depreciation in year 2. And I'm sounding like optimistic and happy about that, which is odd to people at first. People always think depreciation's bad. But again, this is assuming you're going with this product and the money's already been spent. You like being able to use depreciation as aggressively as possible, meaning early, because it's going to end up saving you tax exposure later. How? Well, keep following along with us here to the next slide. So you're selling an extra $250 every year, right? But some of that is increased costs, so minus $125 in new costs. You also get to subtract depreciation. So this blue line, the third one down, is a minus. So it's kind of sales here is the first one. And if you want to think of it, right, with signs here, then minus your cash cost, minus your depreciation, equals your EBT, right? That's your earnings before taxes. So now pay your taxes, right? So minus 40%. So how do you do this? Just multiply by 0.6, or you can subtract 40.4 of each of these things, right? So I can say 46, right? And then I can multiply by 0.4, and I get 18, and that's the amount that I subtract. Or you can just do 46 times 0.6, and you see that you are at 28. So this is another equals bar here, if you will, giving you your net income. And then you get to add your depreciation back. So yeah, this depreciation is bad, quote unquote. It comes out, but it comes right back later. And the only difference in the interim is you're figuring out your taxable base. And if your taxable base is lower because you're writing off more depreciation, you end up lowering these tax numbers. They're less than they otherwise would be. And in particular, they're less early at time 1, say, and at time 2. And it's better to save tax dollars at time 1 and 2 than it is to save tax dollars at time 3 and 4. Right? Because you know that the value of $1 at time 1 is more than at time 2, and which is more than at time 3, which is more than at time 4. So it's the same time value of money principles, just at work again. These give you your operating cash flow estimates, right? So if you're kind of thinking like we have done in the past with an NPV type rule, well, now rather than having the cash flows come to the sky, from the sky, we're kind of in a world where we're creating our own estimates, right? That was our initial outlay. These interim year ones here are now operating cash flows. What am I, 118, 89, and 82, right? So these 1, 2, 3, 4 are my operating cash flows we were talking about last time. But the last period is extra complicated. You can't just use your operating numbers. You also need to factor in your terminal costs or your terminal adjustments, right? Your terminal effects, whatever word you want to use for that. Well, what are some terminal effects? We didn't have any net working capital deal on this one, but we do have salvage, right? It says here that we can sell our equipment for $25,000 in salvage. And here's the deal, folks. You don't get to just pocket all $25,000 of that. That's what's here on this slide, right? So you get to add, in this case, $25,000 more of cash flow, but you don't get to keep it all, right? We owe tax on any salvage value above the book value. Well, what's the book value of this asset now that we're at time 4, at the terminal time? Nothing, right? The entire value of the asset's been depreciated away at times 1, 2, 3, and 4, right? Those blue numbers there, 79, 108, 36, 17, that, of course, all added up to 240. The 240 was actually split to give you those blue numbers, right? So in this case, you sell it for $25,000, right? But you owe tax on anything above the book value, where the book value is 0. So you owe tax on the whole salvage value. You owe 40% tax on anything above the book value. So that's just 10,000, right? 0.4 times 25 is 10. Right? So that's the reason where your terminal effects in this example are a grand total of plus 15, right? 82 plus 15, 97 is your terminal cash flow. Excuse me, your year 4 cash flow. Right? That's the idea there, right? You get the cash flow of your sale proceeds minus your taxes paid, and your taxes paid applies your tax rates to anything above the basis. The basis is the book value. Is it still left for anything on your books? Otherwise, you'd be effectively kind of allowed to save your taxes, to save on your taxes twice here. But say this, everything in words, I think is maybe easier visualized for some by this example right here. What if you sold it after 3 years instead of 4? Well, after 3 years, right? Well, you wouldn't even have a year 4 cash flow, right? So that whole final column would go away. But if we're just talking about the salvage portion here for a minute, on your books after 3 years, this thing still had $17,000 of value, right? So if you sell it for 25, right, and it's on your books for 17, so you haven't gotten to take any depreciation credit for 17 of them yet, right? You owe 40% in taxes on any profit above the book value. So you owe 40% in tax on 8 or 3.2 in tax. Right? So your 25 was what your salvage minus 3.2 leaves you at what, 21.8, right? So that's the idea there, just as kind of an example of one, an example of one where it does still have some book value remaining. Okay. We mentioned it with interest, but it's also the case with dividends. Financing costs are not deducted from the cash flow estimates. They're actually going to still impact a project. Like if you're deciding accept or reject on a project, you're still going to use financing effects, but increased financing would just make your cost of capital higher. So we already had this talk, but you're going to see that from your denominators, from your discount rate, from the number that you put in for an I on your calculator when you're getting an NPV. Right? Financing costs are part of the NPV analysis, but they're not part of the cash flow calculation. Right? All right, so make sure you're ready for that. The sunk cost, here's a couple more examples of what is and isn't material. So what's incremental and what's not. If you're thinking about concept type questions that you might be asked on this sort of chapter. But I'm trying to think what else to tell you here. Sunk costs, no, right? $100,000. This is the kind of the thing where it was already done. The money was spent. A lot of times you'll hear one about commissioning a study, for example, or in this case you were maybe doing some improvement that you end up not going through with. Well, that's sad and the money's spent, but that doesn't affect your cash flow analysis because that $100,000 is already gone. And this is really hard in real life, by the way, for managers to deal with, because if they spent money to do something and then they don't even go through with the product, that's called, it's throwing good money after bad. And everybody at least kind of pays lip service to the idea that, I wouldn't do that. Don't throw good money after bad sort of thing. But people do it all the time. They do it all the time. They suffer and take on bad projects because they feel bad about having paid these sunk costs. So don't do that. Get over it. Yes. Opportunity cost. Here, this is the exact example I was talking about a minute ago about the leasing. I kind of forgot I had this here. Right. That if you had space that you could have leased out for say $25,000, then that is an opportunity cost that you're now foregoing. The opportunity costs and externalities, remember, do get included. They are incremental costs and they should be included in your cash flow projections, right? So in this case, you would maybe subtract 25 per year, or if you did the after tax, you might be say 15 per year that you would subtract. But right, opportunity costs are factored into your actual cash flow number crunching, as are externalities, either good or bad sort of thing. right? This would be a substitute example, kind of like my diet soda thing I was talking about a minute ago. If some of your sales are just cannibalizing, eating your own, just cannibalizing sales that you had get from another project, then those are sales that you would not want to count when you're going to crunch the numbers on your cash flow estimate. So you might, for example, take $50,000 off the top line of the sales when you're doing your OCFs there earlier, right? But we say we already talked about them being complements or substitutes. I often sometimes for substitutes use the word cannibalize if you're talking about just eating up your own sales, for example. And this is just kind of a way of summarizing. Of course, if you would lose the 50,000 in sales of the other product, even if you rejected the new project, then you don't charge it against the new project. Right? What matters is the difference between expected cash flows with and without the new project. And that's not just for externality, that's for everything. But right, the idea is, hey, if I had 50,000 in sales, right, and I was going to lose it anyway, then I would not subtract it off of the top line, for example, as a way from dealing with it. And only things that are incremental that hinge on whether or not your project is actually undertaken are factored in. Replacement projects rather than new product make things a bit more complicated because you have kind of that same idea of like salvage value and stuff. You have to deal with it not just at the ending period, you have to deal with it at the starting period right away. You have old equipment that you might be able to sell, right? And after paying some tax on its salvage value, that has typically a positive cash flow effect right out of the gate. Right? So, say replacement projects that become a little bit more calculation to do than just a brand new project sort of thing. Right? And say, of course, the depreciation will still be an issue as well. Right? Say also, if the firm sold the old machine now, it would not receive the salvage value at the end of the machine's life, which presents an opportunity cost. You can go down the rabbit hole and do more and more versions of this sort of thing, but you'll have practice problems here to try for me, and in doing so, you'll hopefully get a real good feel for the kind of the typical setup of the kind of product cash flow estimates that you'll be held responsible for doing kind of in graded time. Another factor, and it's I think could have mentioned it some last chapter with NPV as well. Something that potentially adds value to projects would be the idea of a real option. Right? Now, I don't go super deep into this here in slides, but there's considerably more in our book and stuff. But the idea is real options take into account that in the real world, if you're in the middle of a project and you're getting feedback that, hey, this is going even better than I thought, or hey, this isn't really working out, we're not selling as much as we thought we were going to sell. If you get information as the project has commenced, you don't have to just sit on your hands forever and hope that your cash flow estimates come out the way you were thinking. You can change tack if you need to. You can stop a project that's not going well rather than continuing to spend money. Or you can expand on a project that's going great in the hopes of bringing in even more additional cash flow. Now, this can be somewhat complicated to do, but I think most people would agree that it's probably important to acknowledge that the ability to move on your feet during a project is something that companies really want to do and can do. Right? So there's different kinds of real options out there that allow you to change course, sometimes for the aggressive, sometimes for the conservative, right, during a project. Sometimes you can postpone certain parts of a project until you get more information. Sometimes you can abandon or decrease the size of a project when it's not going well. That's a more defensive type of thing, of course. Or you can grow and expand a project that's going very well. These are all types of real options. You'll want to be a bit familiar with them, even just kind of knowing the names and understanding what they would sort of do without having to apply as much in a numerical example as a numerical like calculation problem is good. You're going to want to know the terminology here of what these are, sort of thing. And then a couple other things that you might want to know a little. Oh, I think I'm actually got one more slide first, right? So is it likely that a project might have a strategic option value over and above the indicated NPV? This is when we kind of challenge the idea that you know, and especially at like the undergrad level, we're often of the mindset that I'm gonna do my parrot impression. NPV good, and plus NPV do the project. Negative NPV reject. Positive NPV accept. That's mostly true, and that's mostly true even at a corporate context and a graduate school context and stuff like that. NPV and whether it's plus or minus is very important. But there are little wrinkles to where you might do something like horror of horrors, engage in a negative NPV project. One example of that might be that if you have some kind of exposure, or there's a reason, for example, that attorneys, right, will take on high profile cases for free pro bono so they get their name out there. Yes. And there's all sorts of examples of things like that throughout different industries, right? That could be something where you're kind of greasing the skids for the future, but the project itself has a negative NPV. Now, of course, the mathematical rebuttal is, well, then yeah, that's a incremental factor, an externality type incremental factor, and you should try to factor that directly into your cash flows. And you can, but sometimes, at some point you got to call it a day with how complicated a math you're going to attempt to do. So yeah, sometimes you might take on a project that feels negative NPV-ish, right? And the reality is that it's hard to put an exact number on, say, the publicity or exposure or things like that have. So we just kind of recognize sometimes that, yeah, it might have a negative NPV on paper, but a hidden positive NPV, right, above, strategically, we would say, above just the kind of the obvious. This is kind of, say, that reminds me, the kind of the capital rationing idea that's big in the book and such, when we were talking about NPV and other decision criteria. The idea that, hey, a project might have positive NPV, but you might not be able to stretch yourself. You might be stretched too thin if you were trying to do every project with a positive NPV. So at some point, even though it's always positive NPV, do the project, there can be realistic things like capital rationing, right, that would stop that sort of overall kind of first instinct sort of rule kind of thing. Trying to think what else. You're going to want to know what sensitivity analysis and I think there might even have scenario analysis. There might even be a question about that that's potentially fair game as well. So you can check your book for a little bit more detail on sensitivity and scenario analysis. Sensitivity analysis here is the case where, hey, well, let's take a best case, worst case, typical sort of approach, and say, for example, we let our sales fluctuate from maybe a best case scenario of new sales. Our base case might be 250,000 new sales. What if we consider everything from like 100,000 in new sales up to 500,000? Allow yourself like some very sunny upside and some really gloomy downside. Run the numbers and see what the bottom line NPV impact of a project is going to be when your cash flows range, and how sensitive is your NPV number to the assumptions that you're making in your cash flows, right? So don't just run the NPV once based on the average case. Run it more, and you can run it more based on including a best case and a worst case type of thing in sensitivity analysis. I'm trying to think, and then after that, right, in this idea of a scenario analysis, you can sort of get the feeling for the entire playing field. Actually, I believe the book defines it. I think the book actually defines scenario as kind of the spell. So I think I'd even write down or keep in mind. Now it's coming back to me even better. Right, I got it over here. Right, the scenario analysis, right, includes consideration of your best case and worst case ish kind of circumstances. So that'd be one kind of, say, extra tip here for you to keep in mind beyond just what I have highlighted in slides. Right. So I'd say sensitivity analysis is just keeping in mind that the your NPV will change when your inputs change, then your scenario analysis there is particularly tied to the idea of a best case and a worst case sort of thing. Say it's better than just having a point estimate. A lot of times when you're first doing NPV type of calculations, particularly like in undergraduate finance and stuff, there's almost no recognition at all that what happens if I'm wrong. What happens if my estimates about sales and costs and even taxes? What happens when I'm incorrect about those things? How much might I miss by, sort of thing? Right? The biggest advantage of all of the sensitivity analysis is if you tinker with different inputs and outputs to your scenario, right, you can see which one has a big bottom line impact. A lot of times you'll do this sort of thing with like a spreadsheet, the sensitivity analysis, where you'll let pieces of your inputs vary and you'll have everything calculated to give you a final NPV estimate. And just by tinkering with different inputs, it becomes really obvious which is what your NPV is super sensitive to and which things it might be more robust to. At even deeper levels of this sort of thing, you can do computer-based simulations instead. So you can go to the kind of even the next level and do simulations where computers, do 10,000 Monte Carlo trials of of different things that could happen based on the inputs that you give it and give you a feel for the sorts of things that might happen because of a project. But knowing what sensitivity analysis is and that scenario analysis is kind of a special case where you look at the best and worst case is probably the most important concept things for us for now. And say not all of this is completely based on numbers either, right? I mean, some of this is art as well as science. So yeah, knowing the execution and being able to facilitate examples and stuff like that, or work problems in the academic setting for a test or a homework quiz or something like that is of course important for course grades and such. But a lot of this comes with experience in a real world setting too, where you're using things beyond even just numerical projections to come up with some of your estimates and some of the final NPV results thereof.